Thank you, Emily. So today we're going to be discussing nonprofit cost allocations. I have been a staff at Wegner CPAs for 14 years, working a lot with nonprofits during that time. As a matter of fact, I just checked, and today is my exact 14-year anniversary at Wegner.
Well, congratulations.
I can't think of a better way to celebrate than to discuss cost allocation of nonprofit organizations. So here we go. We're going to divide this presentation into three parts. We're going to talk about cost allocation for financial statement purposes, for IRS 990 purposes, and for allocations to federal awards. So the first part involves cost allocations for nonprofit financial statement purposes. And just as a general overview, the expenses of a nonprofit can in general be broken down into two different dimensions. We have our functional expenses, our functional expense classifications, which explain why an expense was incurred. And our natural expense classifications tell the story of what was incurred. Natural expenses are generally going to be pretty much the same categories across most all nonprofit organizations. They are things like personnel costs, occupancy costs, which are rent and maintenance for those who rent their space, or interest, mortgage interest and depreciation for those that own their space. Also things like supplies, printing, postage, accounting, travel, information technology. Those are natural expenses that are fairly similar across most all nonprofit organizations. If we take a look at the functional expenses, the functional categories, generally accepted accounting principles, or we just abbreviate that as GAAP, sets up four basic functional categories: program services, management in general, fundraising, and membership development. Once again, the functional categories are the why that an expense was incurred. The last three of these, management in general, fundraising, and membership development, are known as supporting activities. The program services are really those expenses that are incurred to support the purpose or the mission of the nonprofit. Those are serving the nonprofit's members or beneficiaries. These are the things that you do because you want to do them. Whereas management and general expenses are things that you don't really do them because you want to. They're more done of necessity for the overall administration and governance of the nonprofit. Well, I take that back. Maybe accounting you do just for fun, but the other ones you do because they're necessary to do to administer the overall nonprofit. The last two classifications are fundraising and membership development. And kind of at a high level, you can think of fundraising costs are those costs involved with soliciting contributions or soliciting money. And membership development costs are those costs incurred to solicit members. Most nonprofits do not have membership development costs. Those are fairly well geared towards some specific kinds of nonprofits, such as trade associations or unions. Many nonprofits that have what they call members in their organizations aren't really members for this particular purpose. You only have membership development costs if you have members in which the membership incurs specific duties or is entitled to specific benefits. If that's not the case, then really the costs of getting members for a nonprofit is probably a fundraising cost and not a membership development cost. Another way we want to think about costs of a nonprofit is the distinction between direct costs and indirect costs. Direct costs are those things that are clearly identified with a particular purpose or objective. There is no cost allocation involved with a direct cost of a nonprofit. You just assign it directly to that function. You say this is a direct function of a program or management or fundraising. And if there are indirect costs, these are the costs that are really at the heart of cost allocation. These are things that cannot be clearly identified with or directly related to a single objective or purpose. These are the things that need to be allocated. This is the biggest reason why the concept of cost allocation is necessary. One of the things that we recommend as a best practice is when expenses can be specifically identified with a particular program, service, or supporting activity, it's best if it's done, if it's directly assigned to it, first of all, and as much as possible, it's best if it's done early upstream in the accounting process, right when that invoice is reviewed and approved, and the invoice is recorded into the nonprofit's accounting system. If you can assign that particular cost to a particular function, that's great. The more you can do that, the less you have of indirect costs left over that need to be allocated. So you're making your lives much easier if you can assign costs to specific functions early on in the process. Like one common example might be travel expenses. If employees incur travel costs and those travel costs can be directly assigned to some particular function, go ahead and do that early in the accounting process, right when that invoice is approved or recorded into the accounting software. If you do it that way, then at the end of the day, you have much less in unallocated travel costs that have to be allocated through the cost allocation system. An important distinction to reiterate: indirect costs are not the same as supporting activities. This is something that even experienced accountants kind of stumble over and have to think about from time to time. An indirect cost is something that can't be directly allocated, and a supporting activity is something, a particular function like management in general or fundraising, and they're not the same thing. For example, rent is an indirect cost, but it can be allocated to program services. It's not necessarily just a supporting activity. Whereas accounting is not an indirect cost, it's a direct cost, and it's directly assigned to a supporting activity of management in general. Okay, so now we have to delve into the area of indirect costs and how to best go about allocating them. The basic overriding question you should be thinking about when allocating indirect costs is what is the overall purpose of the cost? Why was the cost incurred in the first place? And there are, in general, a few methods of going about assigning purposes to indirect costs. The most common and probably the strongest method is based on a cause and effect relationship. What activities cause the costs to be incurred? If you can think about that, that's really getting you to the answer of how those costs, indirect costs, should be allocated among the different functions. And having said that, the most common universal method to allocate costs, indirect costs to specific functions is the time relationship. How much time do we estimate staff are spending on particular functions? That's also known as the cost driver. So we can estimate the amount of time that is spent on various functions and allocate certain indirect costs that way. Obviously, the most appropriate indirect costs to allocate based on time would be personnel costs that need to be allocated. Another common cost driver would be the relative space or area of the that is used by the various functions, like the relative square footage of the space devoted to different functions. That could be a cost driver as well, as a way to allocate some indirect costs. And obviously the most appropriate indirect cost for that particular method would be occupancy costs. There are other possible cause and effect relationships or cost drivers that a nonprofit could use as well. It could use, for example, the number of employees that are devoted to particular functions as a basis for allocating costs, indirect costs to those functions. If there needs to be equipment maintenance costs allocated to functions, the nonprofit could determine how much the equipment is utilized directly by the various functions and allocate it that way. If some of the nonprofit's assets are insured and there are insurance expenses to be allocated, it could allocate it by the different ways those assets are utilized across the different functions. So there are many different ways to allocate costs, and as we'll see, there is nothing universal that we can definitively call the one and only right way to go about doing this. There's another overall general way to allocate indirect costs too, which is based on the benefits received. And what that mostly means is allocating indirect costs just based on the proportion of the direct costs that are assigned to each function. So direct costs can be used as a proxy for allocating indirect costs. This should only be used if indirect costs can be shown to benefit all the functions approximately the same amount. And it is generally recognized that that method is not as strong as the cause and effect relationships methods. But nonetheless, it can be an acceptable method if you can justify that that's an appropriate way to allocate your indirect costs. So, as I said before, there is no one right best method. Any allocation method can work if it's reasonable, consistently applied, and well documented. Does an organization have to have a written cost allocation plan? For financial statement purposes, the short answer is no, it doesn't have to. If a nonprofit has a very simple setup and cost allocation is very straightforward, it might be able to get away without having a written one. But for cost allocations that have any kind of remote level of complexity, if the nonprofit is audited by an auditor, such as me, and we find that there is no written cost allocation plan, we will probably consider that to be a deficiency in internal control for not having a written cost allocation plan when there should be one. So that brings us to our first poll question. Does your organization have a written cost allocation plan? And we'll give about 30 seconds to respond.
Just a few more seconds to everybody get your answer in.
Okay. The generally accepted accounting principles do not require you to have a written plan, like I said. And generally accepted accounting principles, one of the things that is required is to disclose in all financial reports that the preparation of financial statements involves estimates on behalf of management, and estimates are a part of getting the financial statements prepared. For most nonprofits, the functional expense allocation is a very significant estimate. So GAAP recognizes that cost allocation does involve estimates, and that there's not necessarily one and only one way to adequately do cost allocation for a given nonprofit. All right, let's take a look at some specific examples of how some cost allocation approaches might work for a nonprofit. Here's a simple example of a nonprofit expense allocation. On the left, we have these accounts, which are the natural expenses. And going across the top of the page are the functional expenses: program services, management in general, and fundraising. Many nonprofits will have multiple program services, so you don't have to have just one. And then at the far right, we have the indirect costs. So these amounts were able to be directly assigned to these functions because they directly relate to a particular function. And these indirect costs are not directly relatable to a particular function, so they need to be allocated. One way to do it would be to allocate the indirect costs all on the basis of time. There may have been what we call a time study done to determine that the staff's time was spent 69% on program activities, 27% on management in general, and 4% on fundraising. When I first started doing accounting work, I would hear the phrase time study, and I didn't really understand what that meant. I thought maybe a time study involved somebody following staff around all day long and jotting down exactly what they did. That's not really what a time study is all about. A time study is more about taking the records that already exist with respect to how staff record their time and analyzing it. So analyzing the historical information about the staff's self-reported time allocations is really what a time study involves. So in this case, we determined that, or I guess the better way to put it is we estimate that the staff's time is spent among these particular functions on those percentages. So we're going to take the indirect costs and allocate them to the different functions based on these percentages. And so we can move all the indirect costs to the functions, and then we have our total of the each functional category that includes the indirect allocations. If we take that same nonprofit, their same basic financial information, another way we could do the cost allocation is to say that, well, for personnel costs, we're going to do that same time allocation as shown in the previous slide. But for these other indirect costs, office supplies, rent, and utilities, we're going to allocate those based on the relative square footage of the facilities that are utilized for program services, management in general, and fundraising. And in this case, we determined that about 67.5% of our space is used for program services, 20% for management in general, and 12.5% for fundraising. And so that's how we're allocating these particular indirect costs into these functional categories. And so we have this total result for the functional categories. The totals here are a bit different than the totals of the previous slide. Which way is better or more appropriate? Well, there is no real correct answer to that. It all depends on the situation and what management feels is the best method. I will say that sometimes we've noticed that people, or I should say nonprofits, overutilize the time estimate as a cost driver for all indirect costs, when maybe that's not the most appropriate way to do it. So that's maybe a common pitfall that we see, is over-reliance on the time estimates as a way to allocate costs for all the indirect costs. But having said that, it's not necessarily the wrong approach in all cases. And the last component of the cost allocation for financial statement purposes that we'll go over involves the special area that GAAP has carved out to account for joint costs. Joint costs are the costs of fundraising activities that also might have another functional component associated with them. The authorities apparently felt that there was too much of a tendency for nonprofits to be tempted to over-allocate fundraising activities to program services. And so they decided that fundraising activities really need to meet a series of tests in order for those costs to be allocated. If those tests are not all met, then the default conclusion is that all the fundraising costs have to be assigned to fundraising. So the three tests are the tests of purpose, audience, and content. The purpose test, the first test, and the third test, content, those are pretty straightforward. Does the fundraising activity include program service or management functions in addition to fundraising functions? And for the content test, does the activity support program content as well as management in general content, as well as fundraising content? So those are pretty straightforward. And the answer to both those questions has to be yes for fundraising costs to be allocated to other functions as well as fundraising. The final test is the middle one, the audience test, which is the most difficult one to meet in many cases. If the audience for the fundraising activity includes prior donors, or if it was selected even in part based on the ability or likelihood of members to contribute money to the nonprofit, then the assumption is that the nonprofit has failed this test and it cannot allocate those costs to anything but fundraising. So if the audience does include prior donors or likely future donors, the nonprofit, you have to demonstrate that this was not a significant factor in selecting the audience in the first place. So if the nonprofit meets those 3 tests for a fundraising activity, those costs can be allocated to functions beyond fundraising. If it doesn't meet those tests, all the costs have to be assigned to fundraising. All right, we'll move on to part 2, which is cost allocation for IRS 990 purposes. There is a particular part of the 990, part 9, that has to be completed by 501c3 and 501c4 nonprofits. That is essentially a schedule of allocating expenses among different functional categories. Not all nonprofits, even if it's a 501c3 or a C4, not all nonprofits have to file a full 990. Relatively small ones can file a 990 EZ, which is a simpler form and does not have this schedule of functional allocations. So that brings us to our second poll question. What is the size of your nonprofit? Are the annual revenues less than $500,000? Are they between $500,000 and $1 million? Between $1 million and $5 million? Or greater than $5 million? Or are you just not with a nonprofit? So we'll give you a few seconds to answer that question. The IRS instructions say that you should use your normal accounting method to complete the schedule. So if you're a nonprofit that has already done the cost allocation appropriately for financial statement purposes, as we reviewed in the first section, then you already have a sound basis for completing the 990, part 9. If you don't have financial statements that have a cost allocation done, then you can use any reasonable method of allocating the costs. The IRS doesn't explicitly say that you have to use methods prescribed by GAAP. That's certainly a safe way to do it. But the IRS stops short of explicitly saying they have to, the allocations have to be done according to generally accepted accounting principles. One difference between the IRS form and the GAAP method is that the IRS only has 3 functional categories: program services, or program, management in general, and fundraising. For GAAP purposes, there was that 4th one called membership development. If there's a membership, if an organization has membership development and does need to fill out a 990 because it's a C3 or C4, then those costs need to be allocated to one of the other functions. And the most common way we see that happening, and what is a perfectly acceptable method, is for those costs to be reallocated to the management and general function. Many nonprofits that have the membership development costs in their financial statements are not 501c3s or C4s in the first place, and so they don't need to have that allocation done because that part of the 990 doesn't apply to them. The IRS has some preset categories that it lists on part 9. And so to complete that part properly, we need to put our expenses into the IRS's slots. And that can involve recombining some of our expenses into the IRS's natural categories, or if we have some important categories that are not part of the IRS's preset natural expenses, we can add them to the IRS's expense categories on that very Part 9 schedule. And there are some expenses which do not go on the IRS functional expense Part 9 because they're moved to a different part of the 990. Rental expenses that are associated with rental income activities, costs of inventory sold, direct expenses of fundraising events, and gaming expenses. These are all moved out of the functional expense part of the 990, and they are put into Part 8, which is essentially a deduction from revenue. That's how they're categorized in the 990. And the last two expenses, the expenses related to fundraising and gaming, if the gaming and the fundraising events were significant, they also go on a separate schedule called Schedule G. The IRS does make it clear that there are some kinds of expenses which in some circumstances can be considered to be program services, even though it might not be obviously the case. If lobbying is part of the purposes of the nonprofit, lobbying expenses can be considered to be a program expense. Costs to obtain awards used for program services can be considered to be a program expense. And costs related to unrelated business activities in some circumstances can be considered a program expense. Unrelated business activities are associated with this thing called UBIT, which is unrelated business income tax that nonprofits sometimes have to incur if they do activities that are not related to their nonprofit function. So if there are unrelated business activities and unrelated business income taxes, those activities in some circumstances can be considered a program expense. So even though these might not be obvious program costs, the IRS does allow them to be considered program expenses for 990 purposes in some circumstances. The IRS also has this lovely thing we saw earlier called joint costs. Joint costs here are not exactly the same as what was discussed for financial statement purposes. Here, the joint costs have a bit more of a narrow definition. The joint costs here are costs that are incurred from combined educational campaigns and fundraising solicitations. So that's a bit narrower of a definition than what we saw for GAAP financial statement purposes. So if a nonprofit does have these joint costs, it needs to disclose them at the bottom of Part 9 of the 990 and also disclose how the joint costs were allocated. So that's the basics of the 990, the cost allocation for IRS 990 purposes. Now we're going to move on to cost allocation for government award purposes, which is one of the areas I know that people are most concerned about. The authoritative guidance for many years was this publication put up by the government called the OMB Circular A122, Cost Principles for Nonprofit Organizations. That has, as of a few years ago, that's now been subsumed into this, this other publication called the Uniform Guidance. Now, both terms are still used in the accounting world. You'll see references both to Circular A122 and to the Uniform Guidance. And many people, including accountants, use those terms fairly interchangeably. The A122 rules, although they're established for federal awards, many other government entities follow these same principles. Dane County, which is where Wegner is based, and probably many of the participants of this webinar are located. Dane County explicitly references A122 as its for its allowable costs and cost principles. The most important point that we can really emphasize with respect to allocating awards, allocating costs to government awards, is that you cannot allocate based on how much unused funding an award still has. I know that's tempting, but that's probably the biggest red flag a nonprofit can do, is to decide to put costs to a federal award or to any government award just because the award needs funding or needs costs assigned to it so that all of its funding can be properly accounted for. It's also the case that all cost allocation all federal awards need written cost allocation plans. Remember, as we discussed for financial statement purposes, just per GAAP, a written cost allocation plan is not an absolute requirement. Well, it is a very clear, explicit requirement for recipients of federal awards. You have to have a explicit cost allocation plan that you're following. And if you don't have that, that will almost certainly be a finding that your auditor will ding you with during the course of an audit. One of the important points about allocating costs to federal awards, and probably any governmental award, is that the costs need to be reasonable, and that generally means they must be ordinary and necessary in the context of that nonprofit's business activities, and they must be adequately documented. If costs are not adequately documented, and the government should never check up on if the award was properly utilized, things that aren't adequately documented are basically the same as not having been incurred at all. And so the government would probably not consider that cost to be to have much of a rational basis for existence if it's not adequately documented. For federal allocation methods, there are a couple basic starting points for methods that are allowed by the government. Some of the methods, we start with allocating the costs into assigning the direct costs into particular cost objectives, and then allocating indirect costs to those cost objectives. And we'll get to these in just a little bit. The uniform guidance lists a few methods that are explicitly allowable, which are known as the simplified allocation method, the multiple allocation-based method, and also the use of specific indirect cost rates. Another method that the uniform guidance says is acceptable is called the direct method. And we'll get to that too. That's, we start with a different set of numbers using the direct method than we do with the other methods. So once again, we have to start with making the distinction between direct costs and indirect costs. And direct costs here has a bit of a different meaning than direct costs did for financial statement purposes. Here, direct costs are things that you can directly allocate to a particular award or any other kind of direct activity of the nonprofit. The direct activity is if it's directly identified with serving the nonprofit's members, clients, or the general public, it should be assigned as a direct activity. And fundraising costs are also direct. So basically anything that can be considered to be a direct objective of the nonprofit should be assigned as a direct activity for these purposes. And just like we discussed with financial statement purposes, any expense that can be allocated to an award should be directly allocated to that award early on in the process. The earlier you can assign a cost to a particular award, the better. The less allocation you have to do further down the road, and just the easier your life is all around. So there's the first method that the uniform guidance says is acceptable is to take those indirect costs, which were not assigned a direct cost in the first place, and then just allocate to the direct categories proportionally by some logical rate. This is a fine method if all the major functions benefit by approximately the same degree. If they benefit from the indirect costs by approximately the same degree, this is a fine method. The important point, the last point, is that you have to take those indirect costs and you can't just allocate them to the awards. You have to allocate them to all the direct cost categories. And we'll show an example of that a bit later. The middle two dots are really language that's taken from the uniform guidance that discuss the specific mechanics of doing this process. But a basic summary is what we have up here. You allocate the indirect costs to the direct categories proportionally by some logical rate. You might be in a situation where you have to use a multiple allocation-based method because, for example, the indirect costs are not benefiting each category by approximately the same amount. So you want to do a different method, such as the multiple allocation-based method. And this basically says that your indirect costs, you put into two different indirect cost categories or pools. And those indirect cost categories or pools are then allocated to the direct categories by different methods. And those methods that the indirect costs categories should be allocated to the direct cost categories are prescribed by the uniform guidance. If you want to take a look at that. Another way to allocate costs to federal awards is to just use a simple, specific indirect cost rate. This is the easiest of the methods that we've discussed so far. One way to get an indirect cost rate is to negotiate it with what is called the cognizant agency, the federal agency with the largest dollar value of the awards for the nonprofit. Or you can use a default de minimis 10% indirect cost rate if you want, in which case you don't have to do any negotiations with any federal agencies. You just apply the 10% rate and that's about it. So like I said, this is the simplest way to do it. You just add the percentage of indirect costs to the direct costs assigned to the award, and you're done. Okay, so before we get to the examples, let's take a look at the direct method. It's basically a different starting point than the other three methods that we just went over. You start with costs that have already been allocated, essentially for financial statement purposes. The uniform guidance doesn't explicitly say that you start with your financial statement allocations, but it says that the allocations are compatible with the approach used for financial statement purposes. So it seems that if you have allocations done already for your financial statements, that's a perfectly fine starting point. And then what you're going to allocate is basically your general costs or your management general costs in the financial statement context. That's what you allocate to your direct activities. And once again, those are done by some rational, reasonable method. All right, so that was quite a bit of jargon, and I doubt that you were all able to follow that precisely. So let's take a look at some specific examples that might be somewhat helpful. Oh, I'm sorry, Emily, I forgot the third poll question. We were discussing indirect cost rates that you could use to allocate your indirect costs to federal awards. And the question is, does your nonprofit use an indirect cost rate for federal awards? Do you use a rate you've negotiated? Do you use the default de minimis 10% rate? Or do you not use an indirect rate, or are you not associated with a nonprofit?
I'll give everybody just a few more seconds to get their answers in.
I know that I've received a couple of comments in the chat about the poll question not showing. And I responded to the two that I know have been having issues, but if that's the case, please let us know and send us your responses so that we can still give you CTE credit if you're looking for that.
Okay, great. So let's move on to some specific examples. Here is how particular costs might be preliminarily assigned to either as direct costs, to specific awards, costs that are unassigned. These are serving the nonprofit's mission. Is fairly synonymous with program service costs that just haven't been allocated or assigned to a particular award, and fundraising costs. This nonprofit was able to directly assign certain costs to these direct categories preliminarily, and now it has these indirect costs, which it was not able to assign directly to those categories, and it needs to allocate for award purposes. Let's say it wants to do the simplified allocation method. And one way it could do it would be based on the relative amount of direct costs that each of the direct categories incurs. So we have $120,000 of indirect costs that should be allocated, and the total amount of the direct costs is $300,000. So that means our indirect cost rate is 40%. So we're going to take these indirect costs and allocate them to each direct category by a rate of 40%. And so that's how we allocate the full $120,000. The important thing to point out here is that you can't just take the 120,000 and allocate it to the two awards. It has to be allocated to all the functions, all the direct functions, including the awards. So you have to allocate it proportionally to things that are unassigned and to the fundraising category, along with the awards. So I hope that makes sense. This is a very important point. Another way the same nonprofit could have approached it, using the simplified allocation method once again, would have been on the basis of direct wages. So once again, it's taking that full $120,000 of indirect costs and is allocating it to the different functions based on the relative amount of direct wages. In this case, the total direct wages was $250,000 and the indirect cost was 120, so it's a 48% indirect cost rate. In this case, fundraising doesn't get anything allocated to it because it didn't have any fundraising personnel costs that were directly assigned to it in the first place. So we're allocating the full 120 once again to the different direct categories. And once again, you can't take the 120 and allocate it just to the awards. You have to allocate it to all the categories that had direct wages. In this case, you have the awards and the unassigned amount. So the result is, under this method, we have award A of 268 and award B of a little over 106. That's a bit different than the approach we had in the previous slide, which is award A getting 257 and award B getting 112. Either method is valid and acceptable, provided that it's rational, reasonable, supported by a written plan, and consistently applied. Now let's say that same nonprofit just decided to use the de minimis 10% indirect cost rate and didn't want to take any of the other mathematical steps. So that's a very simple method. You just take the direct amounts and then you add 10% to those totals. And then you have the total amounts that are associated with the different awards and other functions. In this particular example, the award amounts allocated, or the amounts allocated to awards A and B are both lower than what we saw in the other methods. So you actually have a significantly lower amount allocated to both award A and award B. That might be okay. Let's say the total magnitude of the award A was only $200,000 and the magnitude of award B was only $85,000. Well, just by applying this 10% indirect allocation rate, you've already covered the full amount of the awards, and so you're done. So it might be a perfectly fine approach to use a indirect cost rate such as this in some cases. And then the other method we'll take a look at is the direct method. And once again, this has a different starting point than the other methods. The starting point here, it looks pretty similar to what we saw back on a previous slide way back when we were talking about cost allocations for financial statement purposes. We have these categories, award A, award B, and unassigned, which are essentially the program services. Then we have the general expenses, which were called management in general, back in the financial statement section, and our fundraising. And so the goal here is to simply allocate these general expenses to the different categories, award A, award B, and unassigned. And in this case, we decided to do that by the proportion of direct costs relative to all the costs, it turns out that the cost right here, general expenses are 35,000, direct costs 385,000. And so we use a 9% rate, and that's how we allocate to the awards. And very importantly, we can't just allocate to the awards. We also have to allocate in that same proportion to the unassigned, unassigned category and the fundraising category. And so we end up with these amounts for amounts allocated to the specific awards. So like I said, the big things to keep in mind for federal allocations are, number one, you can't, the worst thing you could do would be to take this 35,000 and allocate it to award A or award B based on how much unfunded amounts those award has. I mean, that's the worst thing you could do. And another thing you could do that's still not acceptable would be to take the $35,000 and allocate it just to awards A and B. You have to allocate it also to all of your direct categories, not just the things that are, not just the cost objects that are the awards. So that is the conclusion of the presentation. I hope that you come away with this with a good appreciation for the basic concepts of cost allocation, and maybe even realizing that the whole process can be a bit more enjoyable than you originally thought too.
Awesome. Well, thank you so much, Brian. That was a ton of information and super helpful. Just a reminder to all the attendees that you will receive this presentation along with the recording of today's webinar after today's event. If you do have any questions, Brian's information is right here on the screen, so feel free to reach out to him. We so appreciate all of your time today. Brian, do you have anything else to add? Final remarks?
So far today has been a wonderful 14-year anniversary at Wedner.
Awesome. Well, thank you so much. And thank you all so much again. We hope you can join us for our upcoming webinars. We have another nonprofit roundtable at the end of the summer, and we have a couple on PPP loans tomorrow. So thank you again and enjoy the rest of your day. Thanks, Brian. Thanks, Melody.